Robinhood's $45 million mistake. The full story. In January 2025, Robinhood was hit with a $45 million SEC fine. The real shocker? They misreported over 392 million customer transactions while secretly making millions of illegal trades. For years, Robinhood operated in the shadows, breaking fundamental trading rules that protect everyday investors. They marked millions of short sales as long, ignored suspicious activities, and even lost control of their systems to hackers who stole data from millions of customers. All while Robinhood executives secretly communicated off the record, hiding their conversations from regulators investigating them. How Robinhood's deception unfolded, their massive penalty impact for your investments, and the 3 critical warning signs you need to watch for. The truth about what happened behind Robinhood's friendly app interface will change how you think about investing. Now let's see what really happened. What happened? Let me take you behind the curtain of what was once Wall Street's favorite fintech darling. Robinhood revolutionized investing with its commission-free trades and slick interface that attracted millions of first-time investors. But beneath that polished surface lurked serious problems that the SEC spent years investigating before dropping the hammer in 2025. The first major violation revolves around something called electronic blue sheets. These aren't your typical spreadsheets. They're critical transaction data that regulators need to monitor for market manipulation and fraud. When the SEC requests this information, brokers must provide accurate details about who traded what, when, and how much. It's the financial equivalent of surveillance footage for the markets. Robinhood Securities didn't just make a few errors. They submitted inaccurate information for 392 million transactions over 5 years. Imagine trying to solve a crime with security cameras that consistently show the wrong person at the wrong time. That's essentially what Robinhood did to market regulators. But that was just the beginning. When it came to fractional share trading, one of Robinhood's most popular features, allowing you to buy portions of expensive stocks, the company began breaking fundamental market rules in 2019. Regulation SHO requires brokers to properly mark sales as long, selling shares you own, or short, selling shares you don't own. Why does this matter? Because short selling creates significant market risks when not properly tracked. From December 2019 until May 2022, Robinhood mismarked over 58 million short sales as long and failed to verify they could actually deliver the shares they were selling. The most shocking part, they couldn't even calculate their own position in the market at the time of sales, a fundamental requirement for any broker. Imagine a bank that can't tell how much money it has. That's essentially what Robinhood was doing with securities. But wait, it gets worse. As customer trading exploded during 2020-2021, Robinhood systems flagged thousands of potentially suspicious transactions that might indicate money laundering or other financial crimes. Federal law requires brokers to investigate these flags and file suspicious activity reports within 30 days. By December 2020, Robinhood had a backlog of over 10,000 unresolved alerts. The company was filing these critical reports an average of 198 days late, more than 6 months after detection. During this time, potential financial crimes went uninvestigated and unreported. And who was overseeing all this? Robinhood executives who were communicating about business through personal text messages and WhatsApp, communications they never preserved as legally required. When the SEC investigated, these crucial conversations were nowhere to be found. creating a black hole in the regulatory investigation. The final blow came in November 2021, when hackers gained unauthorized access to Robinhood's systems, even after a similar breach just months earlier, stealing data from millions of customers. So how did all these failures occur at one of the most technologically advanced brokerages in the world? That's where this story takes an unexpected turn. The consequences. Robinhood's day of reckoning arrived in January 2025 with a massive $45 million penalty, with Robinhood Securities paying $33.5 million and Robinhood Financial paying $11.5 million. This wasn't just a slap on the wrist. It represented one of the largest penalties for these types of violations in recent years. For context, that's more than what many people will earn in their entire lifetime. But the financial penalty was just the beginning of their punishment. In an unprecedented move, Robinhood was forced to publicly admit guilt to specific violations, including their failure to maintain accurate records, properly mark trades, and report suspicious activities. This wasn't the typical neither admit nor deny settlement we often see in financial enforcement. The SEC required them to formally acknowledge their wrongdoing, creating a permanent record that investors and competitors will reference for years. The admission devastated investor confidence. The company that had positioned itself as democratizing finance for everyday people was now exposed for violating the very rules designed to protect those investors. Their reputation, once their most valuable asset, was severely damaged overnight. Most significantly, Robinhood now operates under heightened regulatory scrutiny with mandatory internal audits and compliance checkpoints that will follow them for years. They must certify remediation of all violations, implement new supervisory procedures, conduct internal audits of their messaging practices, create new systems to ensure proper order marking, face regular reviews of their operations. The company that once moved fast and disrupted markets now faces a future of cautious compliance and regulatory oversight. Their fundamental business model, rapid growth through technological innovation, has been permanently altered by these violations. The consequences extend beyond just Robinhood. They serve as a warning to the entire fintech industry. But what can we learn from this massive failure? Lessons learned. The most alarming aspect of this case isn't just the size of the fine. It's that Robinhood's failures reveal a dangerous pattern in financial technology that affects anyone with money in the markets. When we look beneath the surface, we discover the first critical lesson. Technology without proper oversight creates unique risks. Robinhood built sophisticated user-facing systems used by millions daily, but failed to implement basic compliance safeguards. They misreported or omitted data for 392 million transactions, meaning regulators couldn't properly monitor the markets for manipulation or fraud. This wasn't just a technical glitch, it was a fundamental breakdown in market oversight. The second lesson: the appearance of simplicity often masks dangerous complexity. Robinhood's user-friendly interface with fractional shares and commission-free trading hid sophisticated background operations they couldn't properly manage. They couldn't even accurately track whether they actually owned the shares they were selling, a fundamental requirement for any financial institution. But here's what we should be asking. How could a company that attracted billions in venture capital and employed elite software engineers make such basic mistakes? The answer reveals something disturbing about today's financial technology: the prioritization of growth and user experience over fundamental operational integrity. Looking deeper, We see the most glaring red flag came from Robinhood's fractional shares program. When customers bought partial shares, Robinhood made trades to facilitate these transactions, but they lacked the fundamental ability to calculate their own position at the time of sale. They simply marked everything as long, regardless of whether they actually owned the securities they were selling, violating basic market rules. This connects directly to their suspicious activity reporting failures. As customer trading surged in 2020-2021, their systems flagged thousands of potentially suspicious transactions that sat unreviewed for months. By the end of 2020, they had a backlog of 10,000 unresolved alerts, with suspicious activity reports being filed an average of 198 days after detection, far beyond the legal requirement. What's surprisingly interconnected? The same company that couldn't track its positions or monitor suspicious activity also failed to protect customer data. In November 2021, after already experiencing one remote access breach in June, hackers gained access to Robinhood's systems and stole data from millions of customers. The pattern becomes clear. Robinhood prioritized rapid growth and user experience over fundamental operational integrity. They built sophisticated front-end technology while neglecting the basic infrastructure needed to operate safely and legally. So what can we learn from this financial technology cautionary tale? First, the most important question to ask about any financial service isn't about fees or features. It's about their compliance infrastructure. Before trusting a platform with your money, research their regulatory history. The SEC and FINRA publish enforcement actions that reveal how companies actually operate behind the scenes. This is critical due diligence most investors skip. Second, be skeptical of simplicity in finance. When a complex process like trading stocks suddenly seems effortless, someone may be cutting corners somewhere. Real transparency means understanding not just what you're paying, but how the company executes your transactions. Third, and perhaps most important, regulatory requirements aren't arbitrary bureaucracy. They're the guardrails that protect your financial security. Robinhood's failures weren't just technical violations. They represented real risks to market integrity and customer data. The ultimate lesson from Robinhood's case is that financial innovation is valuable, but only when built on a foundation of operational excellence and regulatory compliance. The next time you consider entrusting your money to a revolutionary financial app, remember that behind every slick interface should be robust systems ensuring your transactions are properly executed, reported, and protected. Ask yourself, does this company have a history of regulatory issues? Can they clearly explain how they execute my transactions? Do they prioritize security and compliance or just growth? Watch for these 3 red flags. 1. Rapid growth without corresponding compliance infrastructure. 2. Promises that seem too good to be true, like free services. 3. Lack of transparency about how transactions actually work. If you found this breakdown valuable, hit subscribe for more deep dives into the financial stories that impact your money. That was it for this episode. Hope you liked the content. Drop a comment below with any questions about this case or other financial companies you'd like me to investigate. Hit subscribe, tap that notification bell. Because remember, in the world of financial crime, what you don't know can hurt you.